Good morning. We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Rebecca Choong Wilkins with Annabelle Droulers.
Our top stories: investors eyeing a potential meeting between President Xi and entrepreneurs, including Alibaba's co-founder Jack Ma, DeepSeek's Leung as the next catalyst for China's tech rally.
And Asian stocks are trading cautiously as traders monitor rising tensions between the US and EU and this week's central bank decisions.
German Chancellor Olaf Scholz tells Bloomberg the EU is strong enough to counter President Trump's tariff threats while hoping for a deal to avoid a trade war.
And Trump says Ukraine's Volodymyr Zelensky will be involved in peace talks with Russia, countering criticism that Kiev is being left out of discussions.
We're taking a look at the market action to kick off Monday's trading, and we're really not seeing too much movement so far. We've got the broader Asian gauge relatively flat. We've also got trading volumes looking a little bit thin. There's lots for investors to be cautious about. Firstly, you've got a slew of rate decisions coming up, inflation figures as well out from Japan, the UK, Canada to headline the week, but also these rising geopolitical tensions. Over the weekend, of course, we had more headlines, more interviews out of the Munich Security Conference. And there is that sense that we're getting these rising tensions between the US, also the EU, specifically when it comes to negotiating an end to the war in Ukraine. So we'll get more details on that just ahead. But suffice to say, again, we're not seeing too much movement in the broader gauge so far. US futures as well fairly steady, and the dollar little changed. What else could really set the tone this week for trading, though, is what we get in terms of earnings. Big tech in China, really the key focus. Let's take a look at this terminal chart because we can see, for instance, Baidu, Alibaba, NetEase. These are the key names that are going to be in focus. Baidu actually coming up later on Monday. But taking a look at that rally that we've seen just over the past couple of weeks, really sparked, of course, by DeepSeek. That's certainly really challenged how we take a look at AI models. The question, of course, is what do we get out of these earnings calls? Does that spark the next leg of the rally? Taking a look as well at some credit figures, we had those coming through on Friday. Essentially, we did see aggregate financing, new yuan loans, actually both coming in better than expected. There's a seasonality factor, of course, because January, typically a month that we see a lot of new loans being created, but still, we're against historical levels here. That demand for financing is still looking relatively weak. How this all plays into the session, though, for today, because taking a look at what futures are indicating so far for equities, of course, opening at the bottom of the hour, but we've got them looking, again, if you take a look at the futures here, a little bit to the downside, perhaps. We did actually hear from the PBOC, again, a very busy weekend, but the governor saying that consumption price growth, they still need to improve, although another call as well, Rebecca, just coming through in the last 15 minutes or so, Goldman Sachs has raised its price forecasts.
Right, Annabelle. I mean, to your point about the sort of what is driving this big tech rally that we are seeing in China, we are now starting to see banks adjusting to, more positive momentum. Goldman Sachs raising its 12-month target for MSCI China to 85 from 75. That basically indicates about 16% upside for that gauge. And then for the CSI 300, indicating about 19% from that last close. Elsewhere, of course, we are still eyeing this HS Tech rally. Earlier this month, we entered bull territory. But it's really the focus today about this potential meeting that sources say is taking place between President Xi Jinping and various entrepreneurs in the tech sector. Particularly here, we are watching Jack Ma. Whether or not this is going to be a catalyst to extend the rally, whether or not this is a turning point potentially for Alibaba. Alibaba has been driving that HS Tech rally so far this month. So, of course, continuing to watch that. Elsewhere, we also have this slew of hearings in Hong Kong courts from distressed property developers. We have seen this shift. Liquidation used to be the sort of worst case scenario for investors, but as people have become more frustrated, we are seeing more of these come to the case today. So we're looking at a key unit of Evergrande. We're also looking at an investment of H&A. What a blast from the past there. And Sino Group also has its hearing, although they will be back on Wednesday for this potential approval for a debt restructuring. Elsewhere, we're also looking at Mistral Group. This is the Chinese ice cream and bubble tea company. They're starting to gauge interest for a potential Hong Kong IPO Monday. Of course, that follows the IPO of another bubble tea maker, potentially essentially opening the window for more to come to market. And just quickly, finally, we are entering the window for MLF. Now, this sort of releasing of the timing for this has shifted somewhat in recent months, but essentially, start watching from now, perhaps to the 25th or so. Just a reminder that 1 year is currently at 2% there, Annabelle.
Yeah, it was Gooming, actually, that listed last week. And actually, I was just taking a look at how it's fared so far in the first few sessions. It's actually still below its IPO price. But certainly, I mean, for the sentiment for this week, it's really going to come down to what big tech says and whether this meeting actually does happen. It's still not confirmed just yet. But let's get more on that tech symposium, how it could impact markets as well. We've got our our China correspondent, Min Min Lo, as well as Bloomberg Intelligence equity and strategy analyst Marvin Chen, also with us this morning in the studio. But Min Min, we'll start with you, because really there's a lot of expectation around this meeting and the signal that the CCP could be sending as well about support for the private sector. But what do we know so far?
Well, it's hard to speculate what they will talk about, but we know when President Xi first hosted such a symposium to boost private sector sentiment, he had pledged some moves such as tax cuts, financial backings for some of these companies. So perhaps we could see a slew of measures being announced at the end of this meeting. We'll have to wait for lines for that. So potentially it could be a catalyst that could continue to fuel this rally. But also I think it's got a lot of symbolic significance as well, because you have all the tech titans, the founder of Alibaba, Tencent, DeepSeek, Huawei, Xiaomi, they are all attending. And the fact that Jack Ma is attending, I think, is particularly significant, because he's arguably one of the most prominent faces that has suffered under that multi-year crackdown. His financial company Ant was supposed to IPO in the US in 2020, arguably one of the biggest IPO at the time, that was abruptly pulled off after Jack Ma publicly criticized the Chinese regulators. And he's since sort of gone into hiding or just avoided the public spotlight for a while. But now that he's sort of coming back out and getting an audience with President Xi, that suggests that maybe this is a culmination of that multi-year crackdown and an acknowledgement from the government that they recognize a lot of that disruption and innovation is coming from the private sector, and maybe they need to shift their stance towards private company and maybe pull back a little bit from that common prosperity campaign that's seen as a way to rein in the billionaires and the excesses of the private sector.
Min Min, talk us through some of the potential risks, though, because I'm thinking back to November 2018 when we had the last sort of meeting. There was optimism again from investors then that this would be about kind of doubling down on the private sector. And instead, actually, it presaged this years-long crackdown. So there is this delicate balance for Xi. On the one hand, he perhaps wants to stress, the important role of private sector firms, but he may also state that they sort of, he may also say they prosper at the will of the state, right?
Yeah, he could. So again, it's really hard to speculate what would happen, and I think we have to wait and see. And yes, investors have been burnt multiple times from failed rallies of the past. So it's interesting. What I think is particularly interesting is the timing of this. It's just coming weeks ahead of the NPC. So could this be a sort of informal sharing session, exchange from both sides to get a sense of what the private sector needs from the government, and vice versa? And could that factor into considerations in terms of what sort of policies we could get out of the NPC, because the government had pledged that they want to protect the rights of the private sector better. So I think a lot really is in the details that comes out in the coming weeks.
So Marvin, on that point, the devil in the details maybe a little bit, but markets have already traded off this because we saw that spike in Alibaba on Friday with the initial report coming out. How do you think investors are going to be interpreting what we get out of this, headlines or just the event even taking place?
Yeah, I mean, we saw some of this kind of selling on the news action towards the end of last week. But obviously, these developments are good for sentiment. But the issue with these China rallies is just how strong and fast they've come, right? Many of these companies have gone vertical over the past 2 weeks. And it has been a sentiment-driven rally. Our sentiment, China sentiment indicator is quickly moving from enthusiastic to exuberance levels. And at these levels, historically have been typically associated with mediocre returns. So, there may be some signs of overheating. And, we saw that happen with the October rally last year as well.
And Marvin, what about your outlook for the tech sector? We are now entering full swing earnings seasons. We have Baidu, we have Alibaba coming. How should investors temper their expectations?
Yeah, I mean, there's still large questions around the AI demand and monetization, and these are broad questions for the AI theme. So we don't think expectors are necessarily expecting any, fundamental impact from recent developments. We haven't seen any significant upward revisions in earnings expectations, but we do think markets will want to focus on the guidance on how these corporates will utilize AI and going forward.
And that actually, I'm just taking a look at that Goldman Sachs call, but that sort of AI adoption seems to be underpinning as well their views on why they've upgraded their outlook as well.
Yeah, I mean, I think more broadly, it's a reflection of China making progress on their new productive forces, as it has been highlighted as a key growth driver going forward. So this is a medium to long-term call, I would say, even though we may see some short-term volatility.
Okay, Marvin, thank you. Bloomberg's China correspondent Min Lo and Bloomberg Intelligence Equity and Strategy Analyst Marvin Chen. And later on the show, Global X investment strategist Billy Leung will be with us on the market impact we could see from Xi's potential meeting with Jack Ma. And we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. Good morning. You are watching The China Show. Good morning. Welcome back. You are watching The China Show. On the economic agenda this week, we have a slew of rate decisions. So we have the loan prime rate fixings by Chinese banks. We also have rate decisions from central banks of Australia and New Zealand. On Australia, first of all, RBA, we're expecting they're going to start cutting rates in February, given some of the cooling inflation that we have seen. And in New Zealand, we're also expecting to see, the central bank there delivering quite a large dose of easing. This is according to Bloomberg Economics. It's trying to essentially arrest that downturn that we are seeing in the economy. And also, finally, just keep an eye out for Japan January national CPI and the inflation print coming out there. And turning to the outlook for the global economy, let's bring in Leif Eskesen, Chief Economist at CLSA. Thank you for joining us. Good morning.
Pleasure. Morning.
Let's start with the US. We now have about a month of data, shall we say,
right,
on what President Trump will be doing when it comes to tariffs.
Yeah.
How inflationary are they in your view, and how is that affecting your outlook for growth in the US?
Yeah, so we have seen them off to a quick start in some sense, right? I mean, so we've already seen imposition of tariffs on China, 10%. They have now announced last week reciprocal tariffs. So basically, they're trying to level the playing field with some of their trading partners by raising tariffs on countries that have higher import tariffs on them, where there's also some non-tariff barriers as well, right? So we won't get these new measures for another month or so. They're doing a study on this, but then from April onwards, we could get another round of tariff increases, right? Overall, when we look at it and assess the implications of higher tariffs, not just these we've had now, but the ones to come, it is something that will add to inflation, right? It's added cost for businesses that import. They would then pass some of that on to consumers, so that would also lift inflation for those guys as well. And then you also have that it implies slower growth, right? Because less consumption, less investments on the back of that. Another thing I think it's important to think about, it's not just the tariffs themselves, right, that are negative for growth. There's a lot of uncertainty right now about what's going to happen on the tariff fronts and other policy fronts in itself. So if you look at research that's been done on that front, including from the International Monetary Fund, for example, that actually shows that the uncertainty itself can be as damaging as the tariffs themselves, right? So headwinds for U.S. growth, higher interest rates than otherwise, the Fed staying higher for longer, potentially just cutting 1 to 2 times this year, if at all.
That's what I wanted to ask about, because, of course, we still don't know the scale of the tariffs either. So how do you sort of factor that into the calculations, and how protracted then does that possible inflationary environment become, or re-inflationary environment?
Yeah, I mean, so when we're in this world of high levels of uncertainty, you effectively have to work with different scenarios, right? I mean, so you have a base case that you believe and have more conviction in. So in our case, that involves additional tariffs on China. They're broader on China than they are on other countries. For other countries, it would be more selective in some sense, a bit in line with this sort of reciprocity, should we say, regime that they're pushing out. And then you have to think about when will they start to sort of kick in, right? So our assumption there is during that course of 2025, then it will start to, in a sense, get inflationary beforehand because it starts to get factored into price expectations. We've seen that in some of the inflation expectation surveys already. It's starting to creep in there. It's also starting to creep in terms of consumer confidence to some extent, right? So that's something that is already, in a sense, beginning to play out. Early days still, but it would begin to happen. But in the meantime, the Fed already has inflation. We saw the last print that came in that was pretty strong, right? And both in sort of the underlying level of inflation that's coming in. Labor markets are still pretty good shape. We had a retail sales number out last week from the U.S. that was weaker than expected. But I think some of that was because the weather was extremely cold many places in the U.S. in January. You had a very strong season of holiday spending in December, and then some of the sort of pre-tariff purchases had sort of stopped in some sense as well. But for the Fed, there's this strong resilient backdrop. Then you have the outlook for tariffs being kicked in. So they're not going to be in a hurry to ease monetary policy. They're going to need to see sort of clear, sustainable progress on disinflation. They need to see more weakening of the labor market, basically, before they will start to cut.
Yeah, I mean, just to pick up on that point, part of the sort of inflationary pressures here is going to be defined by the extent to which tariffs, as Donald Trump uses them, are a means of an end, you know, a way of raising revenue, as he's mentioned, or a tool to negotiate deals.
Yeah.
How do you, you know, which side do you fall on? Do we have enough sort of information to really be able to determine that?
So I would actually add another element to it, right? So I think that there are three elements to it. I think one of them is they do want to push through tariffs. Mm-hmm. So it is a goal in and of itself to do that. So that's why we expect that they will come through with more tariffs on China. Some of these reciprocal tariffs will come through. They believe that's important to address the trade deficit. There's a lot of other reasons for that. And they think it's important to protect their manufacturing business. So tariffs are also there as part of an economics, if we say, ideology. Then it clearly is also a negotiation tool, and they're trying to extract other things, both related to trade and clearly also not related to trade, as we saw with Mexico and Canada, for example, right? And then you'll see sort of third options where they can use it also to extract opportunities there, right? So I think it's all three aspects that they're using it for.
The fact that you mentioned just earlier about the Fed only cutting perhaps once or twice this year. Yep. How much are central banks in Asia going to be constrained then by that?
A fair bit. But it's not always equal in Asia, right? So there's some, I think, central banks where we think there's scope for more monetary policy easing. RBA is one of them, right? We expect a rate cut coming up this week, and then we expect a fair bit of further rate cuts over the course of 2025, more so than consensus. I think we're going down to 3.10, if I'm not mistaken, for RBA. Then you also have some scope for monetary easing in India. We have another 50 basis points in Indonesia, another 50 basis points, not necessarily this week, but during the course of the year. And then there are others where it's a little more constrained, right? We don't necessarily think we'll get more rate cuts in Thailand, in Korea and Taiwan a little bit further, but not much, right? So it is constrained both by the Fed, and then it's also constrained by this stronger dollar environment that we are in, right? So there are certain central banks in Asia, of course, that are concerned about imported inflation, right? So they don't want to cut too much and therefore invite that imported inflation through the weaker exchange rate.
China's always, of course, been a bit of the outlier in all of this when it comes to inflation at the very least. So what do you expect this year in terms of any sort of pickup we see out of deflationary territory? And also, how do you think the consumer is going to fare?
Yeah, I mean, so we do expect more policy easing from China, right? So during the course of this year, we expect another 30 basis points to 40 basis points in should we say, the policy rates. We expect another 100 basis points in RRR. We're looking at additional, should we say, conventional fiscal easing, a widening in the central government's fiscal deficit to about 4%. Some of that will be focused on going into consumption, right, to try to lift that, and then some more quasi-fiscal coming in. But specifically to your question, so we do see on the back of that slow creeping up of domestic demand consumption, not much, but it is expected to gradually bottom out. Inflation will also start to sort of gradually come back, but not come close to its, should we say, target yet. But it seems like, at least on the domestic front, they will arrest some of these headwinds. But then you have headwinds on the external front, right? Exports, external demand as a driver of growth will pull in the other direction.
All right, Leif Eskesen there. That was the chief economist at CLSA. Thanks so much for joining us this morning in studio. And we're counting down, of course, the start of trade. Tencent is really going to be a name that we're watching at the open here, because we're hearing that they're integrating DeepSeek into their own apps as well. But we'll have more on that ahead. This is Bloomberg.
And Tencent, Baidu, Baba, Xiaomi, all the big Chinese tech names very much in focus here today, Belle. Tencent, when it specifically about the sort of integration, the beta testing of DeepSeek into the Weixin app, but really underscoring just how ferocious competition here is to take advantage of this AI development.
Yeah, and it's not the first time we've seen a big tech giant in China integrating DeepSeek either, because I think we saw something similar with Alibaba last week as well. So it certainly tells you how much pressure DeepSeek is also putting on those local AI players. But we're seeing really Tencent gaining strongly off the back, of course, Weixin. To remember, it is the mainland version of WeChat, or what it's known then as there. But futures broadly for the session today, taking a look at what we're seeing ahead of the opens here. We had been guiding for a bit of a weaker start. We'll be tracking, of course, whether that extends into the open. Hang Seng, though, actually looking for some gains at the open. More ahead. This is Bloomberg.
Welcome back. You're watching The China Show. We are counting down to the open of markets here in Hong Kong, just a minute away now. And really, the narrative that is dominating is all about tech. We have this meeting between President Xi Jinping and Jack Ma, among other tech entrepreneurs, potentially spurring enthusiasm or optimism that there's going to be some kind of reprieve signaled from Beijing for the tech sector, for the private sector, after this big DeepSeek success. The other narrative here, of course, is still this really sort of ferocious tech rally that we've seen so far. The HS Tech, of course, entering bull territory earlier this month. We're now sort of exceeding those October highs that we had, and it does look like there's still quite a sort of significant degree of momentum continuing.
Yeah, that's right. And we're actually going to be taking a look at how the Hang Seng is faring in just a moment. Have we surpassed that October level? I'll check that in just a moment. But here we've got the CSI 300 coming online this morning. Again, we actually had seen futures indicating for a bit of weakness. But just as we come online this morning, there is a headline that is tracking very well so far. This is Tencent, of course. We're seeing its shares jump, but we do understand that they're testing DeepSeek integration of it into its Weixin app, which, of course, is what WeChat is known as in mainland China. But that is the broader market there. Hang Seng, of course, we're tracking this about 1% higher so far. I do want to check that level to watch. 22.70. Yes, we've surpassed that. we've surpassed the level, the October peak now. So we are coming off what's been a 5-week winning streak. And again, we're going to be tracking that tech sector very closely because you see the Hang Seng Tech Gauge, for instance, 1.7% to the upside. Earnings is going to be the really big test this week. Not only, of course, yes, beyond the symposium between President Xi and also these chief or key entrepreneurs in China, chief among them, Jack Ma from Alibaba, of course, or the co-founder of that business, but also earnings, as I said, one of the key sort of litmus tests of whether this can extend, because others are a little bit more sanguine. For instance, our Bloomberg intelligence team saying that really there's not enough right now to justify a fundamental re-rating of some of these names. Baidu, one that has had that perception that it's been missing out on the AI rally. It had been, for instance, passed over last week by Apple, that now says it's going to be working with Alibaba instead to roll out Apple Intelligence. So Baidu, perhaps a bit of a laggard, but you do see it just a little bit weaker here. Again, we have seen it integrating DeepSeek into its search engine, but maybe not enough.
Yeah, to your point there, Baidu also reporting on Tuesday, so we'll keep an eye out for that as well. But speaking, Belle, to your point about this potential meeting between President Xi and Jack Ma, there's a question about whether or not there's a catalyst to extend the rally in China stocks today. For more, let's bring in Billy Leung, investment strategist at Global X. Billy, tell us, what are you expecting from today's meeting?
Yeah, sure. So thanks for having me. So I think in terms of the meeting, we have to really take a step back and look at, obviously this is very symbolic in terms of Xi calling a meeting, arranging a symposium meeting. But if you look back into historically, we've seen this happen probably once during 2018, end of 2018, when Xi very similarly called a meeting between private enterprises. During that time, the outcome of that was very much more on the narrative side. There was recognition, there was acknowledgement, but there was very little to do with actual, policies or actually support. So to me, I think in terms of looking at this actual meeting, I think in terms of symbolic, yes, but in terms of market impact, I think there are much more to actually look at in terms of what's really driving this tech rally.
Yeah, so Billy, I guess that puts a lot of focus on the earnings this week as well from Baidu, Alibaba, for instance, NetEase. What are we expecting, and is that going to justify the next move higher, do you think?
Correct. I think in terms of the earnings this week, especially with Baba, it's really about the narrative. It's really about how the management will describe or actually explain the impact of what they had in terms of AI, or even impact of what DeepSeek will be in terms of integrating in their products. And I think this will be the key. And I think in this earnings especially, it will probably overcome in terms of numbers. So I think the only numbers that will really matter, apart from the narrative, would really be more related to cloud computing and whether or not AI will be impacting it. So I think, for this week, or for more of the China tech earnings, we really need to look at the management narrative on artificial intelligence with this tilt towards what they're going to say about DeepSeek.
Billy, I mean, there are some who are saying the rally has been overdone, and that, we're now sort of seeing too much enthusiasm. If you didn't invest and you missed the moment earlier this month, can you still make money?
Yeah, I would actually challenge that. I think there is still a potential for a higher level, especially with HS Tech. I think this is not just to do with, what's developing with DeepSeek, what's developing in artificial intelligence. This is more about people or market realizing that there is an option with the China equities market. To put this into perspective, what we saw since the DeepSeek announcement probably about 3 weeks ago, the HS Tech rally, but it wasn't just about the AI. We also saw, for example, Xiaomi, Kuaishou, and also Meituan rallying as well, and I would sort of see that less to do with AI or less to do with DeepSeek. But taking a step back, and if you look at like she said, into more context, if you look at HS Tech or even HSI, it still has been underperforming the MSCI World or the MSCI World substantially in the past 5 years by at least about 40%. So I think just taking a step back and putting things in perspective, we are still potential to catch up and potential upside to see from this level.
A lot of those names, though, they are very domestically focused. Do you think that the weakness in the Chinese economy is still going to continue to present sort of hurdles for these names as well?
Yeah, I think that's a good question, but I think we're swinging too much in terms of looking at consumption or even look at property issues. I mean, if you look at what's I guess what China could be or what China has been focused on in terms of the last 5 or 6 years, it has been very much focused in terms of innovation and technology. China has been very I guess talking a lot about in terms of self-reliance, and I think this could be what's driving the next decade or even the next 2 decades of China. So having said that, yes, there is that economic I guess issues with China. But if you look at what innovation can bring in, it's still very early stage. I think globally, if you look at artificial intelligence in terms of productivity, it's only brought in single digits compared to what we could do historically with innovation. So I think the same thing with China. We're very early stages, and I think the future growth could be more looking at how much productivity artificial intelligence could drive, and second, how much earnings or how much investments these large innovative companies could be investing, and potentially we could see what we saw with the US Mag 7 investing substantially in AI capex, and this all impacting or all benefiting these adjacent sectors.
I mean, Billy, that's a good point in terms of this focus on earnings, this focus on growth. But of course, investors have been very, very driven by statements that have come from authorities. We have the MPC coming up. What do investors need to hear? What's the minimum level that they need to hear from the MPC in order to sustain the momentum that we've seen so far?
Yeah, that would be something I'll be cautious on, considering that, in terms of the upcoming 2 sessions, we've already had the Politburo meeting at the end of last year. We also had the working conference earlier this year. So in terms of any incremental positives, I will be rather cautious on. So I think in terms of the upcoming meetings, it will be more on overall growth in terms of China this year, setting the targets. It will also be highlighting that, we could be increasing or slightly increasing fiscal deficit. And it could be also saying that, there will be a slight improvement or a slight decrease in inflation. And I think these are all, I would say, priced in the market. If I was going to look for anything positive outside of this, it would be actually a better than expected fiscal deficit level.
I want to ask about Tencent in particular because, of course, we've just had this news in the last few minutes that they're looking at integrating DeepSeek into WeChat or Weixin in mainland China. How do you read that, and which names have the greatest potential for you? I'm curious about this in particular because, of course, these names like Tencent, Alibaba, Baidu, they have their own AI platforms as well. So integrating DeepSeek to an extent, you think it kind of cannibalizes their own push.
Yeah, so I would think in terms of Tencent, Weixin integrating DeepSeek, this is more of, I guess, a larger story or larger phase in terms of where artificial intelligence is heading. So I think in terms of the bigger scope of things, we're looking at artificial intelligence going to a phase where we, relied heavily in hardware. The hardware has improved substantially, and now we're at a stage where infrastructure and adoption is going to be critical in terms of leveraging this hardware. So going back to your question about Tencent, I think that's a, great or an expected move in terms of why, now we have, I guess, much stronger platform, much stronger infrastructure, and they're adopting DeepSeek into their services, which would also increase, I guess, their search capabilities within their Weixin app. Now, back to your additional question of, how it's going to impact in terms of each of these statements. Look, I think in terms of how artificial intelligence has been happening around the world, it's all been actually beneficial for each other in terms of improving and in terms of, leveling up for each of the platforms. And I think that one reason why DeepSeek was so successful was because through a process of distillation where, they use different platforms to actually improve themselves. And I think this is something that could be used widely and expected to actually lower the cost substantially, not just for Chinese companies, but even globally.
That's Billy Leung there, investment strategist at Global X. Thanks so much for joining us this morning. Tencent, of course, really the name to be watching very closely. But Jeffrey's just out with the note as well, saying that this integration is an important milestone for Tencent in becoming an AI super app or agent in the future. But we'll have plenty more ahead. This is Bloomberg.
The French President Emmanuel Macron is inviting European leaders to Paris on Monday for urgent talks on Ukraine and Europe's wider security. Bloomberg senior editor Derek Wallbank is with us now. Derek, just talk us through why it is that we are having this urgent meeting and also the extra pressure that has really been injected by President Trump because, of course, of his discussions and negotiations with Vladimir Putin.
Rebecca, sometimes you will ask me a question and there's a long, convoluted, complicated answer. This one's really simple. They don't know what he's doing. Donald Trump has been moving very unilaterally with regards to what he's doing in terms of Ukraine, his calls with Vladimir Putin. His call with Putin was not broadcast to European allies in advance. There is a concern on the European continent that Trump is making these moves without the consultation, that he, based on some comments that he has made, that some of his officials have made, Defense Secretary Pete Hegseth, among others, may be giving away too much too early before the negotiations start. And there has been an undercurrent of concern, additionally, at what Europe may be asked to do to be able to keep any peace that Trump makes, right? Trump has talked about increased defense commitments from European nations. That's increased money as well as increased obligation. And there is also, I would say, this undercurrent of, if the United States is going to have an overall pullback in some way, to some degree, what does that then mean Europe has to do? I think those are all sort of macro questions that are underlying a lot of the European nerves right now.
And of course, there's Ukraine's involvement in these talks as well, and it doesn't really seem like they're an active player, at least from the US side right now.
Yeah, well, and I think that's going to be a thing that's looked at very closely going on now, because Vladimir Zelensky, the leader of Ukraine, has reacted with a certain amount of surprise to some of the moves that are going on, right? He is playing a delicate balancing act right now. He needs U.S. support to continue, but he doesn't necessarily feel, based on his comments, that he's been read in as much as he wants to be. And at the same time, he needs to keep his own options open, right? Zelensky has made very clear that he doesn't want to guarantee that he would sign on to any deal that may be put in place. There has been a long time idea from the United States and the Biden administration that there was not going to be a solution to what is going on in Ukraine without Ukraine at the table. But in the early days of the Trump administration, Ukraine hasn't necessarily been at the table when Trump is calling Putin unilaterally. Now, there are promises that Ukraine will be at the table, but there was also some suggestion that some of the talks that are being set up were catching Ukraine off guard, that they were said that Ukraine was going to be there, but the Ukrainians may or may not have known about those meetings or may not have agreed to them already. So there's a lot of uncertainty at the table right now in terms of what Ukraine knows, how involved it is.
Derek, a lot of those uncertainties that you mentioned really were sort of discussed at the Munich Security Conference that we had over the weekend. Last week on Friday, we also had comments from Chinese Foreign Minister Wang Yi, really calling the U.S., sort of calling out the U.S.'s bullying tactics, essentially, saying that China would respond to unilateral sanctions. Just tell us what we're hearing from Beijing.
Yeah, well, Beijing is trying to take a little bit of a cautious tone, right? They're definitely trying to push back on some of the actions the Trump administration has done, is talking about doing. The 10% tariffs that were levied are a good example of that. But when we're seeing the Chinese commentary, it mirrors the Chinese response that we saw to those tariffs. It's muted. It's not nothing, it's definitely something, but it's not as far as it could be. And one of the things that Wang Yi was saying is, and I was struck by some of the messaging that he put out there, where he's saying, if things continue, we will have to, casting China's responses as potentially a forced inevitability that they don't want to have to take, rather than outwardly bellicose language. So there is a desire, I think, on the Chinese side, if you sort of parse through, to keep things at a more even, balanced tone. Remember, Trump has talked of his respect for Xi Jinping at the same time that he has said that he thinks that China is taking advantage of the U.S. and that he wants to make up a significant amount of money through tariffs. But he has so far stopped short of some of the levels of tariffs that we heard promised in the presidential campaign that Trump just won. So there is a sort of delicate kind of balancing moment right now for the U.S. and China. It's going to be an open question how long that lasts. If Trump decides that he wants to go further, what does that look like? But right now, that's kind of the temperature check that we're getting from Wang Yi.
That was our senior editor, Derek Warbank, there. And sticking with duties, because that was also a focus of those conversations over the weekend, German Chancellor Olaf Scholz says the European Union is strong enough to stand up to President Trump's tariff threats. Even so, Scholz tells Bloomberg exclusively that the EU is open to talks to avoid an all-out trade war.
I have to admit that I'm in favor of free trade. I think this is a big advantage we have in the world, and that many of the wealth and the growth we have in the world is because of free trade. So it must be fair free trade, yes, but free trade is better than tariffs and protectionism. I don't think that this will work.
So it should lower tariffs?
When it comes to the European Union, I think everyone knows that we are a big economic area with a lot of strength, where policy about tariffs is something that is our common policy. So we are strong enough to react to everything that is harming European economy. But we should react always, but in a way that is always offering the chance for an agreement, because it's better for all parties involved, especially on the both sides of the Atlantic.
But is the European Union considering cutting tariffs before any announcement on cars?
We invite the United States to discuss with the responsible authorities about what we can do for a better progress that serves all of us. There is a willingness. And so I'm sure it's better if we agree to something that helps all of us. And it is good to know that Europe is strong enough to act and to react.
You talk about it being a common project, but Donald Trump has made clear that he wants to do reciprocal tariffs. He doesn't want a WTO approach where all the rules are on the same countries. And even with the European Union, he might want to have a different tariff regime for France and Italy and Germany. What would you do then?
The European Union is a unified economy and has...
but there's nothing to stop the US doing that.
But it has common tariffs, and we act together, and we will stick together, which I think is also important. And so I'm quite confident that a good solution is feasible, and everyone should work to make it happen.
German Chancellor Olaf Scholz speaking exclusively with our head of economics and government, Stephanie Flanders, there. And here are some of the world stories we are following this morning. Taiwan is said to have praised the positive and friendly wording on the island on the US State Department's updated website. That's after it removed the phrase that Washington does not support Taiwan independence. Official language used to describe US-Taiwan relations is highly sensitive. Previous changes to the State Department's fact sheet on the island have provoked an angry response from China, which claims Taiwan as part of its territory. The Australian government will ban foreign investors from buying established houses for the next 2 years as part of an election pitch to tackle surging home prices. The ban will start from April 1st until end of March 2027. Australia's home prices are some of the most unaffordable in the world. Soaring prices are expected to be a key election issue amid a broader cost of living crisis, especially among younger voters. There is plenty more ahead. Stay with us. This is Bloomberg.
Taking a look at how we're faring so far in the session, just about 20 minutes into trade so far. And look, there's a lot of green across the screen. And the main theme, of course, is tech, but there's some other ones to track as well. And this one is off a story that the Chinese government is going to be transferring 4 finance company stakes to the sovereign or a unit of the nation's sovereign wealth fund. And so we're seeing those rises off the back of that. So there is this expectation we could see further deal making in the brokerage sector. So investors are going to be keeping an eye on mergers and acquisition possibilities. So that's that story there. But also, again, as I said, the big story today is what's happening in the tech space. And we're actually seeing the Hang Seng Tech Gauge, for instance, going back to levels that we haven't seen since 2022. So we're at a 3-year high for the broader index. Today, Tencent shares are jumping in particular because just in the last half an hour, we've had this story coming through that they're going to be integrating DeepSeek into their WeChat app in mainland China. Alibaba, of course, have got the earnings coming up this week, but we did see again the optimism not only around DeepSeek, but also just generally because we've got this meeting, this symposium perhaps taking place where Jack Ma could be meeting with President Xi. So it tells you maybe this years-long crackdown and this regulatory overhaul on the big tech sector could be finally firmly done, a signal perhaps of support for the private sector, but other names to track as well. Meituan, Kuaishou, I mean, we've got a lot of earnings coming up this week too.
Big question mark when it comes to that meeting, whether or not it's going to be an opportunity for President Xi to signal his support for the private sector, the crucial role it will play in new productive forces innovation, versus whether or not he will remind the private sector that really its role is also there to serve the state. You know, part of this comes down to the reasons why we had that crackdown on some of those consumer tech names in the first place. Perhaps this issue that they were became too powerful, became too dominant in markets.
Yeah, I guess to not to pour cold water on it, but yeah, maybe investors, of course, sometimes do get ahead of themselves a little bit before these key meetings.
No,
but
really?
Never happened. Anyway, what we're seeing in the Asian equities today, we've got the CSI 300 pushing higher, but again, very much a Hong Kong story and perhaps another day of a southbound rally. But more ahead, this is Bloomberg. Welcome back to the China Show. Taking a look at the Hang Seng half an hour into the session today, and there is broad upside. I mean, we're a little bit off the highs of the day, but still we're tracking back at levels that we haven't seen since October of last year. And when you dig into the specific sub-indexes, for instance, Hang Seng Tech, we're at a 3-year high. So there's a lot of optimism, and you're coming off, of course, yeah, I mean, 5 straight weeks of moves higher. Are we heading into week 6? I think there's a lot of unknowns. Firstly, that symposium perhaps between political leaders and entrepreneurs in China. Also earnings, that's going to be another really big test.
Yeah, absolutely. And, you know, I think just a reminder, back when we sort of saw one of these similar symposium, November 2018, there was originally actually a sort of a few month rally after that. There was hope that this was a positive sign. And then, of course, it became clearer that we were actually seeing the beginning of really what was quite a crippling crackdown, a years-long crackdown, not just on the tech sector, but, of course, many private industries in China. So I don't want to be a Debbie Downer, but just to, you know, calibrate expectations and put a little bit of context here on this meeting today. But it is really a focus on whether or not we see Beijing coming out to support the private sector very vociferously.
Yeah, and it does seem, of course, that there is that growing awareness that you need the private sector and you need that innovation to also contribute very strongly to the growth of the economy. But someone who has, just to note as well, been missing out on a little bit at this rally, that's Michael Burry from Scion Asset Management, because he did reduce holdings in JD.com and Alibaba at the end of last year. Still among his top picks, though, to note, but that is one of the most read stories on the terminal this morning. Changing on, taking a look at what's happening. I mean, China is the big story, but the other one today, of course, is what's happening in Japan, because we had the GDP figures coming through and we actually saw it accelerating on an annualized basis, 2.8%. That's way above forecast, because I think it was for around 1.1% growth instead. So it does really support that BOJ decision to resume rate hikes in January. And you are just seeing a little bit of yen strength after those figures today as well. Broadly as well for Asian equities in the session today, we did come in with a pretty cautious note to start the week. Trading volumes, I'm just taking a look at those. They're a little bit more elevated again, particularly in China today. but it is as well those other stories in the headlines. Firstly, we had the headlines dropping out of the Munich Security Gathering or Council meetings over the weekend at the end of last week, but those rising tensions between the US and China, or rather EU and US as well, how that sort of also complicates the end to the war in Ukraine, central bank decisions. I mean, there's quite a lot for investors to keep on top of.
Yeah, there's a lot that they're mulling over. Of course, we have the RBA decision. We also have a decision out the New Zealand Central Bank coming through this week. So a lot to consider. The Munich Security Conference, the focus, in fact, did seem to be much more on, this question of EU-US relationship and also how we get to the end of the war. China's response, we had commentary from the foreign minister, but China's response did seem a little bit moderate in tone, which is really in keeping what we've seen from Beijing so far. We haven't had the sort of fire and fury. They do seem to be wanting to avoid getting into that spiral of tit-for-tat retaliatory tariffs here.
Yeah, and actually just to note the last programming note for the weekend events, because it was quite a busy one, we also had the PBOC Governor Pan speaking in Saudi Arabia, saying that there can still be more to go in terms of picking up price pressures, so inflation, of course, getting out of that deflationary mindset, and consumption as well has a ways to go. But let's get more analysis on what's happening, because as we said, there's a lot to cover. Bring in our MLife strategist Mark Cranfield joining us this morning from Singapore. And Mark, for a starting point, it seems like we do need to kick off with what exactly is happening in the China tech space and how much further this rally can extend.
Well, if you're an investor, the only thing you need to know is Jack is back. If you have a long history looking at what's happening in the Chinese tech sector over the past 5 years or so, your world changed in the fourth quarter of 2020 when the Alibaba company, Ant Financial, when their IPO was cancelled. And a lot of people pinned that on the Chinese leadership as a way to pull back on their expressions to do with the tech sector. That time, as Rebecca was saying, they were clamping down on Chinese companies, and the defining point was the cancellation of that IPO. If you look at the performance, particularly of a big company like Alibaba, ever since then, it has underperformed its US peers dramatically. And now, if that situation is changing, if the Chinese leadership is about to re-embrace the tech sector, then the upside potential is pretty big, because they've got 4 years worth of stuff to catch up on here, more than that, in fact. And so really, that's what investors are very excited about, is the possibility that this long underperformance of Chinese tech in relation to their US peers finally could be starting to turn. And you throw in as well the DeepSeek AI advantage as well. That's also obviously helping to boost the sentiment as well. Let's see if we're still assuming that President Xi is going to embrace Jack Ma and the other leaders. Maybe he's not. But if he does, it's really going to help to spur what's going on in the market. And if you think in terms of whether this is overdone or not, certainly by some measures, people are saying that the HSI tech index in particular looks a little bit overextended if you look at RSI measures and those kind of things. But if you see how often in the past Chinese-related stocks have managed to keep the rally going for a very long time when people thought it was already dead. If you think back to late 2017 into early 2018, the H-share index had 19 consecutive days when it closed higher. And the RSI stayed in overbought territory for more than 2 weeks. So that's the kind of thing you can expect. If people really believe in this rally, it could stay overextended for a long time.
Mark, if Jack is back and we do see animal spirits returning or continuing, I suppose, in Chinese markets, does that change what investors want and need to see from the two sessions meeting in March?
From the two sessions, really, what investors will be hoping for, of course, is some kind of endorsement in general of the tech sector. But in a way, more importantly, is just to let it behave itself. Let the government stay out of the private sector. One of the things that has really upset investors over the past few years is every time the private sector seems to be doing well, the Chinese leadership puts their foot in it. And it then is a backtracking effect on the private companies. Just leave them alone. Leave them to run their business. Let them make their money. Let them innovate. That's what the investors want to see. They want to see the same kind of freedom for tech companies in China as you get in the United States and other parts of the world. They actually want the Chinese government to sit back and just let it happen. If they do that, if they get through the two sessions with some general terms which suggest broad support but without really anything specific. That would be the best outcome as far as investors are concerned.
Mark, I want to turn to Europe quickly as well. We have Macron organising this urgent meeting of European leaders. Of course, the story here is uncertainty over precisely how Donald Trump is going to go about ending the war, his discussions with Putin, which they didn't receive notice of. We have, I think, a 4-day, maybe that's 5-day Euro streak of losses. Just tell us what we should be watching here. And, of course, we have elections in Germany.
The biggest concern here for traders is about the numbers that potentially defence spending will have to increase by a very large amount as far as Europe is concerned. If we're reading this correctly, what Donald Trump is trying to do, he's trying to pass the whole bill onto Europe. He wants to see a solution for Ukraine and end to the war, but he wants Europe to pay for it. And he wants them to pay more for their defence spending in NATO. European government bonds are not prepared for that. The euro currency is not prepared for that. So there's this meeting with Macron and the other leaders, something investors will be looking very closely for if they put any numbers, any precise numbers on how much Europe is willing to pay to help to build up defences and help to pay for the rebuilding of Ukraine. If those numbers are there, if they're very big, then the government bond markets in Europe are really going to be staggering because they're not ready for that at all. And it will probably undermine the euro for a while until the European Central Bank is able to calibrate itself. Because it will also mean that rate cuts can't come as quickly as you would expect in Europe as well. There's a lot hinging on what kind of numbers we see come out of the meeting between Macron and the other leaders.
Bloomberg MLive strategist Mark Cranfield there. And just a bit of breaking news crossing our desks here. The Hong Kong court is ordering the liquidation of an Evergrande unit, it's a key Evergrande unit, Tianji. And just for a little bit of context, a judge had already moved up its hearing date, so it was already expecting to get less respite than it initially had thought. This comes just over a month after the court ordered a liquidation of another Evergrande unit. So this is really about liquidators who are at the end of their tether trying to recover assets as quickly as possible in what has been a very protracted and delayed process from Evergrande itself.
Yeah, and also just to note, we've had Thailand GDP figures just dropping, and we've seen those actually undershooting what economists had been predicting here, but coming in at 3.2% for the fourth quarter year on year. The estimate had been 3.8%, so still a pickup from the prior reading. But, I mean, we had seen some pretty mixed indicators for household spending because consumer confidence, job vacancies, those slumped, even though you've seen wage growth in the Bank of Thailand's private consumption indicators strengthening. But, again, just to say that the GDP figures have risen 3.2% and, again, undershooting what economists had been tipping.
Thanks, Bob. And turning back to China, we are seeing credit expansion there picking up more than expected last month from a year ago, with 5.1 trillion yuan of new loans, the most for the month of January on record. But the jump failed to reverse its entrenched slowdown in demand for financing, which we've seen really persist in China. The surge in credit growth was partly driven by a record jump in government bond sales. Meanwhile, elsewhere in China data, we saw record outflows of foreign direct investment last year. Net FDI dropped by $168 billion in 2024, the biggest capital flight in data going back to 1990. Let's bring in Becky Liu, head of China macro strategy at Standard Chartered Bank here. Let's start with some of these numbers. In a way, it's sort of a mixed picture that we saw. How concerning are you, first with FDI, and then how do we make sense of the somewhat contradictory credit data that's come through?
Sure. The FDI data is primarily a reflection of interest rate differential because these FDI data include all the outbound repatriation of all the earnings by those MNCs in the previous few years. So we have seen quarters of consecutive withdrawal of all those earnings from the domestic market, and this trend will have to continue so long as we still have such a wide interest rate gap between the two. However, from the credit data's perspective, we also feel view, it's primarily driven by seasonality, because January typically would be the month of stronger credit growth. But what's more constructive in our view is that mortgage loan growth rebounded for the first time ever in the fourth quarter of last year, and that's after 7 consecutive quarters of decline. So that's indeed supporting a mitigation of the pressure in the real estate sector. But more broadly, currently we are in a data vacuum for January and February data, but from the very limited data we are able to see the momentum, it's not very strong. For example, PMIs are really falling below 50 again, and we are seeing the likes of new home sales, land sales, and so on are still moderating from the same period of last year.
So FDI, when you dig into it, you're saying it's better than you expected. And the credit figures as well, when you drill into it, you're saying, again, better than expected. So are these just two broadly positive then, would you say?
We feel that the FDI is not as bad as it appeared to be, because it includes both repatriation as well as new investments. Right. But when it comes to the credit data, we're still relatively concerned. After all, we still see new Chinese loans or CNY loans down by 20% in 2024, and it takes a bit longer, especially we need rates to be much lower for a sustainable recovery of credit growth at this point.
I want to ask about tariffs and the impact of tariffs, particularly to the PBOC. We had the likes of Lombard saying that, essentially the PBOC policy is being hijacked by Trump's tariffs. I mean, to what extent is the risk of tariffs and the tariff threat hampering the PBOC's ability to move?
For a change, CNY stability is now taking a much higher priority at this stage. So instead of having a competitive devaluation of the currency to offset the impact of tariff, China choose to stabilize the CNY while move something else in order to offset such an implication. So from the fourth quarter PBOC monetary policy report that was released last week, things are relatively clear that, number one, they would like to maintain FX stability at this stage, which will hinder their ability to cut rates or cut triple R in a very aggressive way in the short term. But it doesn't mean they're not going to do it. The wording is interesting. They said we almost tell you we want to keep things stable, but once we see a window, we want to cut, and the cut could be more aggressive in our view. So given the tech rally, the risk momentum is coming back. If we do have a situation for dollar CNY moving back to the fixing level, we could as well see the PBOC cutting immediately.
Okay, that's a good point there. If they see a window, they will. So just lay out a little bit more detail. Under what circumstances and when might we see the PBOC be willing to let the yuan weaken?
That would depend on the performance of the dollar. Because at this stage, if we look at the tariff implication, so far, since Trump's inauguration, China is the only major economy that's really subject to higher across-the-board tariff. Yet, dollar CNY did not really move. And from China's perspective, it's really not about FX competitiveness. If you have a trade surplus up 20% to almost 1 trillion yuan $1 trillion US last year, it's really telling us that it's already very competitive. And therefore, from China's perspective, it's an important question to ask whether the U.S. tariff is more important or whether tariff from the rest of the world is more important. So over the last few years, we are clearly seeing that China export to the U.S. has actually been declining, but for the rest of the world has been growing, and the growth is more than offsetting the losses from the U.S. And therefore, when we started to see other economies, the likes of Indonesia, Saudi Arabia, and so on, already hiking tariff against Chinese goods, not for political or geopolitical reason, then we could say that if they cheapen the CNY even more to make the Chinese exports even more competitive into those markets, then the risk is for other economies to be hiking tariff against China. So to conclude, China will only move the dollar CNY upper bound from the current level of around 735 to a higher level when the XY is much stronger, because the goal is not to gain FX competitiveness, but instead to reduce the cost of intervention.
There's still then that need to try and improve consumer sentiment within China. How do you see that right now, and how do you see that, say, post-NPC and any sort of announcements we get as well?
it's at the Central Economics Work Conference, so they're quite clearly telling us that this is the priority among all the tasks of this year. So we do see a scope for policy support. So first of all, we do see they would be broadening all these consumption support from the previous programs, for example, subsidizing the purchase of white goods. But this year around, we see them widening the scope to into the services sector. So very clearly, Chinese retail sales or services production is way below trend. It's not even back to 2019 level. So there are a very wide gap, but it also means they have the potential as well. But it's going to be a very slow and long-term process because at the end of the day, domestic consumption is a function of household balance sheet. And if you still have a falling real estate market, a relatively weak job market, then more hope would be put on the equity market to revive consumer sentiment. And we believe it will happen, but it's going to happen very slowly.
Yeah, I mean, we're seeing that emphasis again, of course, on the equity market playing out today. Becky Liu, head of China macro strategy at Standard Chartered Bank there. Up next, distressed Chinese property developers are facing a slew of court hearings in Hong Kong this week as the risk of liquidation rises for some developers. We'll have more details coming up on that story. You're watching The China Show. Good morning. This is Bloomberg. Good morning. You are watching The China Show, and it feels a bit like it's Liquidation Monday here in Hong Kong. We have an H&A unit ordered to liquidate by a Hong Kong court. We also have a Hong Kong court ordering the liquidation of this key Evergrande unit, Tianji. Bloomberg's China credit reporter Loretta Chen, who has been across the story from the beginning, is here to help us break it all down. Tell us first, I think, let's stick to property. We are seeing more pressure to liquidate Chinese property developers. Explain the rationale and then explain the significance as well, specifically of what we're seeing happening at Tianji.
Yeah, so these liquidation or winding up usually happen in the first place because creditors want to use that as a means of a negotiation with the company. But of course, in Evergrande's case, it was liquidated a year ago, the main group. So it was actually liquidated by the same judge as the judge that pronounced the liquidation of 2 units today, so Justice Linda Chen. And that landmark case basically paved the way for all these liquidation cases that we're seeing right now, a year after that main liquidation. And I think that's the part of the liquidator's strategy, which is they try to get to these offshore units of Evergrande. And today, the Tianji unit that's liquidated has been a guarantor to some of its Evergrande's offshore dollar bonds. It has over 200 subsidiaries in mainland China, Hong Kong, and BVI. So that provides a means for the creditors to reach to some of the assets under Evergrande, as the unit itself actually has over $5 billion in debt.
So these liquidations, or forced liquidations, then, where does that tell you about where we are now in the whole property crisis and the cycle of it?
Yeah, well, I mean, the justice, when she decides on the liquidation, she says these 2 units are clearly insolvent, both the H&A unit and Evergrande unit. That underlies the rationale of a lot of these liquidation, which is that the company has not the ability to pay back any of its debt to creditors. So the most viable ways for the company, for the creditors, is to just go for the liquidation so that the creditors can recover whatever they can through asset sales through this process. Again, it's going to be a long process. It's a year from Evergrande's liquidation, and we're only seeing 2 key units being liquidated. And, there's going to be more to come. But again, whether or not these liquidators can actually reach the onshore assets, which is the bulk of where money lies, still remains a question. And separately, Evergrande's executives benefited $6 billion from dividend payments, et cetera, over the past couple of years. and where will that money be paid for its creditors remains a question. Whether they can recover any of that or not remains a big question.
Josh, I want to ask about H&A as well. I mean, there will be people who don't even remember what happened at H&A. It was such a long time ago. It's been going on for so long, and longer indeed than Evergrande or any of these property crises. Just tell us if there are lessons that investors can learn from the process at H&A.
I think H&A was regarded as more of a successful case because it was taken by the provincial government of Hainan. So that's a very different from Evergrande, where the executives were actually, going through criminal procedures. I think the H&A case, in a way, it tells us that even after restructuring process successful of the company, you still have these remainder of the past debt crisis that needs to be resolved through that court procedure and could last for years, as we're seeing, really more than 2 years after H&A's restructuring.
All right, Loretta, thanks very much for joining us. That was Bloomberg's China credit reporter, Loretta Chen there, and we'll have plenty more ahead. This is Bloomberg. Well, all roads continue to lead back to DeepSeek this morning because we're taking a look at what's happening with healthcare stocks. Ping An is the one that's really moving the most, but broadly gains here, and it is this story that perhaps there could be an extension of the recent rally. Citi's got a note out on this saying that if there is that integration of DeepSeek into these various platforms, it could lead to revenue improvement and also margin expansion as well. So it's just that continuing pickup and driving further productivity gains out of AI, and that has really been the central story for a lot of Chinese equities.
Yeah, we've seen a lot of Chinese companies, really this ferocious competition to try and integrate DeepSeek as quickly as possible, even some tech firms that have their own competitors potentially.
Yeah, that's right. I mean, we saw, for instance, Tencent jumping this morning after it said it was going to integrate DeepSeek into WeChat. Alibaba had the same last week. But again, those southbound flows, big rally from that side into Hong Kong. It's 10:29 a.m. in Hong Kong, taking a look at what is happening this morning because we are just continuing to see, look at it's mostly high for Hang Seng Tech. We've seen the CSI 300 off the highs of the day to trade flat. But the real theme really still relates back to DeepSeek and, for instance, Tencent. You can see they're up 5% this morning, integrating DeepSeek into its WeChat platform or app in mainland China. Alibaba ahead of the earnings later this week. We've got the symposium that could be taking place between President Xi and key entrepreneurs in mainland China, including Alibaba co-founder Jack Ma. So a signal perhaps that we do have much greater support for the private sector in China. Baidu to the downside, earnings are due tomorrow, Tuesday, but it has sort of missed out on some aspects of the AI rally as well. Really lots to dig into, but as we say, all relates back to DeepSeek.
Yeah, I mean, let's dive a little deeper there. We'll bring in our China correspondent, Min Lo. I mean, Min, we're already seeing really this rapacious appetite from markets for good news from this symposium. But just tell us, what are we really expecting to see?
Yeah, so this is not officially confirmed or announced by the government. It's from our reporting from sources from various other media as well, that President Xi could be meeting with a group of tech titans, including the founders of Alibaba, Tencent, DeepSeek, Huawei, for instance, and it's a symposium meant to boost private sector confidence. The last time President Xi had held such a symposium in 2018, he did announce some friendlier policies, including tax cuts, for example, and also support financial backing for these companies. So there are a lot of expectations now about whether we could see a similar move after this meeting. The fact that it comes just a couple of weeks before the NPC is also interesting. Could this be a sort of information exchange that could factor into considerations in terms of what sort of policies we could see coming out of the NPC? And of course, symbolically, you have Alibaba's Jack Ma attending this, getting to meet with President Xi. He is perhaps that poster child of someone who has suffered so much from that tech crackdown several years ago. The fact that he's sort of perhaps, you could say, rehabilitated or perhaps now in the safe zone, that also fuels a lot of optimism around the tech sector as well.
And we're trying as well to sort of figure out, are there more DeepSeeks in China, or is this sort of the only one right now? What do we understand on that front?
Well, China has been pouring a lot of money and resources to really build out its domestic infrastructure. And there has been so many startups that just sprouted out, over the last few years. So we are watching a number of players. Of course, all the big players like Tencent, Baidu, they have their own AI models. And possibly one of the front runners now is Alibaba's Q1. They released their latest model over Lunar New Year, just days after DeepSeek caught the attention of the world. And Alibaba claiming that it outperforms Meta and Google, for example. There are also lesser-known names, but very up-and-coming one like Moonshot. They have the Kimi model, which is founded by a Tsinghua University professor who previously worked in Google and Meta. It uses the same reasoning model as DeepSeek. There's also Kai-Fu Lee, a very well-known name. We had him on our program a few months ago. He founded E, which is another AI model that is closest to commercialization now because his company claims that they have the lowest cost compared to the industry leaders when it comes to building and training its AI models. So they're working with industry players to work on real-life applications there. So quite a number of, actually, if we show, we did show that the screen there with the list of AI players. Those are some names we're watching out for, and it's possible the next sort of DeepSeek disruption could come from China, just given how they have been forced to really double down on their self-sufficiency push and to think out of the box, given the restrictions from the US.
All right, that was our China correspondent Min Min Lo there joining us. And the DeepSeek phenomenon has also triggered concerns that the AI tech gap between China and the US may not be as wide as once thought. Let's bring in Toby Walsh, Chief Scientist at UNSW Sydney's AI Institute. And Toby, thanks so much for joining us this morning. Last year, and perhaps even sooner than that or earlier than that, we had been thinking that the US really had the lead in this race, particularly with ChatGPT, but also other platforms as well. Where do we stand today, do you think, in light of DeepSeek's release?
Well, I think it's really put the cat amongst the pigeons. It's demonstrated that there is really no gap between what's going the best of the West and what's going on in China. And it's more than just the technical lead. There's no technical lead in China. It's the fact that they did it for just $6 million or so. So the Silicon Valley mantra of scaling is all you need. It was a race for who had the deepest pocket, who was going to throw the most money at it, has now been thrown wide open. If you can do it for just $6 million, it's available to anyone. So it really is anyone's race to win.
What do you think about the model approach as well? Because DeepSeek, of course, is open source. Not the same case in the US. It's really dominated by big tech. Do you think that in a way that US approach has also stifled other innovations?
Well, yes. I mean, previously it was a case of, who could throw the most money at it. And that's no longer the case. DeepSeek's model is open. Indeed, they've been very transparent about how they've trained it. And the thing here is it's a bit like running the 4-minute mile. When Roger Bannister, the first man to run the 4-minute mile, ran the 4-minute mile, then lots of people were able to do it. And the same will be true for these AI models. Now that we know that you can do it, and indeed they've published a lot of the details of how to do it, a lot of people are going to be able to recreate this at modest cost. There are a bunch of initiatives around the world to rebuild DeepSeek's model. There's a big project, for example, on Hugging Face. Hugging Face is this open collaborative platform where we share our AI models to reproduce it. So I'm going to expect a lot more similar advanced, sophisticated, capable models to appear now that DeepSeek have demonstrated that they can do it.
Toby, Rebecca here. To what extent is this a China versus US story, as opposed to, for example, just seeing a different approach to AI? So, I mean, when we look at, for example, DeepSeek, there are, of course, allegations that it was trained off ChatGPT. It is open source. One way to describe it is perhaps the accumulation of so-called best practice rather than kind of very expensive innovation. I'm just trying to understand, is this bifurcation a division between the China and US approach, or is this something we should expect to see across AI more broadly?
Oh, you can expect to see it across AI more broadly. Everyone is going to be training on the outputs of previous models. It's not just the Chinese companies like DeepSeek. They're going to be able to profit from the existing AI models. That's a phenomenon that all of us can profit from. So it does demonstrate that the trade restrictions, the limitations on exporting GPUs to China have failed to give the US a technical lead. Indeed, I suspect necessity was the mother of invention here, that China has been able to catch up because of those restrictions, because they were forced to have to do more with less, to work with second generation chips. That's encouraged them to be innovative. But we can expect other countries to be able to also play in this game now as well, because they'll be able to do the same that DeepSeek did.
So, as you've written recently, that if the ultimate goal isn't about building AI that runs on large data centres, but to build AI that can run on your smartphone, how close are we to that move to the so-called edge, where you have in-device AI and that becomes the norm?
Well, still, if you want the best models, the most capable models, you're going to have to run them on very large amounts of hardware in the cloud. But increasingly, things are running on your phone. I mean, that's Apple's approach, for example, Apple Intelligence. Much of Apple Intelligence runs on your phone. There's lots of technical advantages to that. That means, for example, you don't share your data with anyone. It actually stays on your phone. So there's lots of reasons to suppose that we're going to go that way. When you don't have connectivity, you can still run your AI application. So ultimately, I expect we are going to have AI that runs on our phone. We're going to have 8 billion artificial intelligence. Each of us will have our own artificial intelligence. It's not going to be one big service. And we're making progress. There's still a long way to go that. ChatGPT is an example. I mean, all of us were impressed by ChatGPT. That cost 30, 40 million. We're not exactly sure because they weren't totally transparent about it. Some colleagues at the University of California of Berkeley have actually built a ChatGPT clone for $300 of Amazon Web Service credits. That's a 10 to the 5, 1 followed by 5 zeros reduction in the cost to do that. So we can expect similar advances to be made with all of these models, that they will get smaller, faster, and quicker.
Toby, we've already seen national security concerns raised over DeepSeek. We have governments from the US, Taiwan, Australia banning the use of this software on government officials' devices, for example. To what extent do these concerns ultimately hamper the development of AI as well as sort of open source AI?
Well, I mean, the interesting thing is that DeepSeek is open source, so you can actually download it and run it on your own phone. And then there's really minimal security risks. I mean, it's data isn't going into or out of your phone. Everything is staying there. So actually, it is an opportunity for actually a much more secure AI model than running one of the US tech giants where you're sharing data with someone else. So surprisingly, it actually offers some advantages. Ultimately, I can see us ending up really with two different AI worlds. I mean, we've ended up with two internets. We've got the internet of the West, and then in China, we've got a completely different offerings. The tech giants in China offer, completely different services. I can see us ending up very much the same with AI, that we have the offerings from the Western tech companies, and then we have the Chinese tech companies offering a different sort of AI with different trade-offs to be had from the different provisions.
What about the regulation front as well? Because different AI sounds conceivable, but regulation already looks very different between the US, Europe, and China as well.
Well, actually, I suspect we're going to see a lot less regulation. I was at the AI Action Summit in Paris last week, and feeding into that was the DeepSeek shock, and it was summarized by the Vice President J.D. Vance's speech, where it was, let's loosen all the restrictions. This isn't a race. Everything is still to be won. Let's restrict the limitations, the regulations that we put on AI. And indeed, you see, European Union backpedaling somewhat on the regulations on, for example, liability provisions for AI. So I suspect at the moment we're looking at a lot less regulation, a lot more hell for leather, as you might put it.
Okay, Toby, thank you so much for joining us. That was Toby Walsh, Chief Scientist at UNSW Sydney's AI Institute. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function TV Go. You can also join the conversation by sending instant messages to our team and our guests during the live shows. Please do go check it out at TV Go. You're watching The China Show. Stay with us. This is Bloomberg.
Well, major US banks are scaling back investments and cutting jobs in China amid mounting trade tensions between the two nations. Meanwhile, the new US investment rules on sensitive technologies like AI, formalized under the Biden administration, have come into effect. Our finance editor Adam Hay joins us now. And Adam, we're talking about a market that's worth $67 trillion. That's the size of financial services market in China. But how big or small even is that market now for some of the Wall Street banks that once really wanted a large slice of that pie?
Well, Annabelle, I do think that's a great setup because, I mean, it just gives you the sense of just how massive a market is. So the fact that these US investment banks are pulling back and are continuing this pullback does really show you what's at stake here. What's at stake is this massive kind of question. They're saying, well, it's just not worth the risk at the end of the day. There's so much color and tension in this story. Of course, that, you know, we lead off with kind of those Treasury official discussions and some of the big banks that are involved in those. But really, when you drill down to the numbers, I think that's one of the elements of this story which really just makes it so good. And let me just give you a few numbers here. So go back to 2023, the combined exposure to China from all the banks, which includes lending, trading and investments, are down by a fifth, right? And that's just $34 million. So just in that 1 year, just imagine $34 million of profit, just such a tiny number relative to what these banks make, you know, in other parts of the world. And of course, it hasn't just been, you know, the US banks. There's been a lot going on for European banks in China, of course. Some of those have still been able to have some level of relative success there. But I think really it's about this difference between what's going on in the mainland, where you've still got a lot of kind of joint ventures that are happening, but staff levels have just pulled back so much so that you still have some Hong Kong operations and staff levels have decreased there. But a lot of these banks are just making the decision that it's just not worth it, despite everything you said about just how massive an opportunity and how massive a market this is. It's just not worth it for them. There's too much uncertainty there.
Adam, there were some players, Bank of America, Morgan Stanley, who avoided spending massive amount of capital in expanding their China businesses. Were they right to do that?
Well, I think we're kind of starting to see, aren't we, Rebecca, like vindication of just how much of a kind of smart strategy decision that's been over a number of years. So, I mean, you singled out, you know, a couple of names there. There's clearly quite a distinction between the banks that decided not to invest large amounts of capital into mainland China and those that did. And what you're seeing now is that, you know, those ones that are still having to pull back, still having to make a lot of adjustments to decisions that were made really at the top level of these banks many years ago, but are now building towards the sense that they really have to reduce the scale there even more. So indeed, that, you know, the likes of Bank of America and to a lesser extent Morgan Stanley just shows that I think that decision really originally to say let's not go into a market like this too gung-ho has proven to be reasonably prudent as history's played out the way it has in recent months.
Bloomberg finance editor there, Adam Haig. And subscribers can read the big take story and all about bankers trying to navigate this confusion and caution around regulation around China. You can see it in full on the terminal by searching NI Big Take Go. And in some corporate headlines we are following this morning, Bloomberg has learned that TSMC is considering taking a controlling stake in Intel's factories at the request of Trump administration officials. Sources tell us the deal would have TSMC fully operating Intel's US semiconductor factories and would address concerns about Intel's deteriorating financial state. TSMC is said to be receptive to the idea, but it's still unclear whether Intel is open to a transaction. Elon Musk's AI startup xAI will release its Grok 3 chatbot with a demonstration on Monday. In a post on X, Musk described the product as the smartest AI on Earth. Musk has said the model can reflect on mistakes it makes by going back and forth through data. Grok 3's debut comes as more and more competitors emerge to challenge OpenAI's ChatGPT. And Bloomberg learns that Apple is planning to add AI features to its Vision Pro headset as it seeks to boost interest in the device. Sources say it's aiming to roll out the upgrades in April, along with an updated mode for guest users and a spatial content app. Apple is expanding Apple Intelligence to the headset, just as Google announced its own mixed reality operating system that integrates its Gemini AI. There is plenty more ahead. Stay with us. This is Bloomberg. Time now for Trending in China, a look at stories hitting the headlines in national newspapers and making a stir on social media. Xinhua is highlighting China's participation at the Munich Security Conference, saying it's played a constructive force in a changing world. At the same time, the piece is highly critical of the Trump administration, quoting experts who said its actions indicate a disrespect for the international order. The story criticized US Vice President J.D. Vance's speech at the conference, as well as Washington's withdrawal from the Paris Agreement and the WHO.
Meanwhile, as China's official media celebrates the box office success of the animated film Ne Zha 2, it has not been quite as enthusiastic about the latest Captain America movie. Global Times says Captain America's Brave New World's political correctness and emphasis on individual heroism is not resonating in China. It says, quote, the singular focus on individual heroism no longer satisfies the increasingly diverse aesthetic demands of Chinese audiences.
It's also drawing some strong and nationalistic reactions on social media, with users comparing Captain America with Ne Zha 2. And a few comments that we're seeing here, Belle. One, that there is such a wide range of Chinese offerings that Captain America 4 just isn't a priority. Other comments saying that these two films aren't even comparable, that Ne Zha 2 is about family, friendship, loyalty, and fighting when fate treats you unfairly. Unsurprisingly perhaps, that a film like Ne Zha, a topic that seems to have so captured the imagination of people, eventually it does sometimes seem that these topics always end up straying into nationalistic territory on social media. So perhaps not a huge surprise that we are seeing more and more comparisons between what this huge Chinese blockbuster offering is providing versus some of its sort of US competitors right now.
Well, yeah, and I think sometimes it just comes back down to basics. Is it a good movie or not? And I was just having a look at the IMDb scores and Rotten Tomatoes, actually. I think we can just say Rotten Tomatoes. Everyone knows it, the different ones. For Captain America, its score is 50%. So, it's not just the Chinese audience that doesn't like this film. I think there's other people as well. Ne Zha 2, though, it's got 99% rating on Rotten Tomatoes. So they're obviously vastly different films in terms of how they're being received by a lot of different viewers worldwide.
Are you going to go watch it? either of them?
Honestly, I'd rather go watch Neja 2 based on the reviews that I'm reading. I think it sounds better. All right, markets-wise, let's also take a look at what's happening in the session this morning, because a lot of exuberance really across the board here today. Taking a look at the robot stocks, for instance. So we've got this possible tie-up between Unitree and Meta. We know that Meta is making a really big play in humanoid robots. Unitree actually is considered one of the robot darlings in mainland China, based in Hangzhou. And so we're hearing that, again, that these two could be working together. Meta could be looking at investing in this company. Meta, we know as well, working on its own humanoid robot hardware. So we're seeing those stocks rising here today. Another one, of course, to keep an eye on this morning is what's happening with Tencent, because just in the last hour we had these reports coming out that Tencent is going to be integrating DeepSeek into its WeChat app or platform in mainland China. That's Weixin, of course, but we are seeing that stock rising here today. So yet another big tech player in China that has integrated DeepSeek into its offering. So we are just seeing these ones rising. Earnings, of course, to note, Alibaba is due out later this week. Ping An Insurance, actually, I should note that one as well, because we've got this expectation we're going to see further integration and further productivity gains from AI coming into different offerings. But it's very much a southbound rally story as well.
Yeah, I would just note that although we've seen these big gains in tech driving the broader index, actually it is sort of spreading to outside. We have bio names, consumer names also up there as well. Anyway, we'll keep watching that. You're watching The China Show. This is Bloomberg.